Remember last year when we were all complaining about gas prices? When the national average peaked at $3.49 and several places in the US were paying more than $6 a gallon? Well, it's no surprise that oil and gas companies clocked record profits in 2022 to the tune of $200 billion. The White House was already frustrated with gas companies. They repeatedly emphasized that oil and gas companies were not doing enough to increase production and keep gas prices down. While you and I stood in sticker shock at the pump, oil companies were laughing all the way to the bank. But the shit really hit the fan when Chevron announced a substantial $75 billion share buyback program they intend to implement over the next 5 years. White House Press Secretary Abdullah Hassan said, and I quote, "For a company that claimed not too long ago it was working hard to increase production, handing out $75 billion to executives and wealthy shareholders sure is an odd way of showing it." But it's not just oil and gas companies. Stock buyback programs are very trendy right now, and we need to understand what they are and why they happen. When a company has extra cash just laying around, they have to decide what to do with it. They can invest in research and development, buy other companies, build new technologies, or distribute it back to shareholders. One way to distribute it back to shareholders is via a dividend. Companies are hesitant to commit to shareholder dividends. For one, it looks terrible if you eventually cut it or reduce it. Secondly, dividends are taxable income to shareholders. So many are opting to engage in aggressive buyback programs where the company actually goes out and buys their own stock back. Doing so can be positive for shareholders in a number of ways. If they pay less money for the stock than the company actually thinks it's worth, then shareholders see an increase in intrinsic value. Buybacks also decrease the number of outstanding shares, which means the earnings per share, a key metric analysts follow, actually increases, which in turn can also increase the value of each share. If an investor holds on to the stock and doesn't sell it, it's not taxable. Well, it wasn't, at least. It is now, with a new 1% tax on stock buybacks. And last night, during President Biden's union address, he called for it to be quadrupled to 4%. Those opposed to stock buybacks believe they don't bring real value to the company. They say it enriches shareholders and executives while failing to improve the quality of the business and their goods and services. Critics think cash should have been used to invest in innovation or expand the business. Those who support stock buybacks say they aren't really that big of a deal. Companies are constantly issuing new stock in the form of executive compensation, and the buybacks are just offsetting that. All companies are doing is preventing the stock from being diluted. Besides, the duty of the company is to the shareholders, and this is a very efficient way to create shareholder value. In reality, it's not the strategy itself that matters, it's the intent of the company. If they truly believe their stock is currently undervalued, then using excess cash to buy it back at a lower price is a good move. If companies are doing it just to boost their earnings per share, or worse, borrowing money to buy shares back, or even worse, using federal support dollars given as aid to buy back shares that aren't trading below value, it's not a good long-term move for shareholders, taxpayers, and it's certainly not sustainable. One thing is for sure, with 2023 anticipated to be the first year stock buybacks cross the $1 trillion mark, the strategy is likely to have a meaningful impact on Wall Street and investors. That's it for this week. This is Jeannie, the 401k lady.